When Wall Street is functioning properly, it can play a critical role in growing and helping our economy. But when Wall Street goes off the rails, it can become an economic wrecking ball. So what ultimately governs the direction Wall Street goes? One basic concept: incentives.
For the first 200 years, Wall Street was made up of a series of small private partnerships. And the people who ran those firms had their own capital at risk every day. So not only could you lose the capital you invested, you could lose your entire net worth. All of the art collections, everything that they had bought out in the Hamptons, all of that could be lost if one of their partners did something stupid. And basically that preserved a sort of an equilibrium in our economy throughout much of the 20th century. But fast forward to the 1970s and 1980s, when all the firms started going public, that whole dynamic was changed. Because suddenly, you could get all this easy money from third parties, from banks who would provide you with credit lines, from public investors who would buy your bonds, or from equity holders who would invest in your stock. And so this whole culture of being a steward for your own capital and for everything that you had built up in your life got completely thrown out the window and substituted by this bonus culture where everybody on Wall Street was motivated by one thing: generating as much revenue as they possibly could to try to get as big a bonus as they possibly could every year, using other people's money to do it.
With the prudence that private partnerships naturally creates no longer in effect, incentives for the newly named CEOs changed dramatically, as they now had the freedom to generate bank profits using other people's money. But recognizing this potentially massive conflict of interest, the industry took steps to keep CEOs on the straight and narrow by overhauling executive compensation, tying CEO pay directly to the performance of the bank. On the surface, this seems like a pretty reasonable solution, but as I would soon learn, this new pay system had a fatal flaw, a flaw that would become a catalyst for the entire financial crisis.
So there was a revolution, that's what they called it, in executive compensation. And in this revolution, they said, hey, we have to worry because CEOs may not be loyal to the shareholders. They may loot them. Okay, that's good. We agree with that. And therefore, what we need to do is basically bribe the CEO not to loot the shareholders. But of course, it did exactly the opposite. So what it said is, if you report for accounting purposes higher profits, you, the CEO, will get a whole lot more compensation. Well, that doesn't align my interests with the corporation. I control the accounting. I can do the scam. I would far more like to engage in fraud, get the sure thing of reporting record profits, and get a lot of wealth.
This new system tied CEO bonuses to how much annual profit the bank reported. However, instead of ensuring that CEOs made responsible decisions to make those profits, it incentivized them to push for profitability at all costs, even if that meant making those profits up. And Wall Street execs didn't have to look far for inspiration, as a group of CEOs from a related industry had already developed a perfect recipe. Over in the mortgage industry, CEOs had come up with a way to generate giant bonuses for themselves by making ungodly amounts of bad loans to borrowers across the country. And far from being repulsed by this behavior, Wall Street wanted in on the action. So the banks, each of whom had vast stores of cash that the uninsured mortgage companies would ultimately need to survive, approached these lenders with an offer they couldn't refuse.
Mortgage lenders. They would end up striking a deal with an investment bank who would provide a warehouse line of credit. So as example, how much volume do you think you can do in a year, says the investment bank. Well, let's say $100 million. Perfect. We're going to give you a warehouse line of credit for $100 million, and we're going to charge you 4% on that line. And once you originate $100 million of loans, we will take those loans, and that will free up your warehouse line to start again.
There's Wall Street money. It flows into these entities. These entities make loans, package them up, give them back to Wall Street. At this point, Wall Street was even dictating the terms, and so they were telling them what kind of loans to produce. So Wall Street was really pulling the levers here for how this was going to happen.
Banks positively encouraged and indeed by contract often demanded that these refugees to the shadow financial sector make more predatory loans.
And that is why.
Because the officers of those banks made a ton of money if they could get the lender to make predatory loans.
So it meant reaching out to more borrowers who probably couldn't pay, borrowers who didn't have the right income, and it led to rampant fraud. So the push was coming from above, from the big Wall Street banks, and the pressure went down the chain to the mortgage broker at the street level, who was getting more and more pushed to make more loans.
Wall Street's partnership with the mortgage lenders evolved into a well-oiled machine, making executives on both sides filthy rich at the expense of their own institutions. This explains how millions of borrowers like Addie got caught up in an epidemic of mortgage fraud. But how did this contagion manage to spread into the rest of the economy, infecting pensions of people like Dan and Larry? It all comes down to one simple insight. Not satisfied with simply making money off of these toxic mortgages until they exploded, these bankers realized that they could get them off their books and make even more money by repackaging and reselling them to investors.
If you're a pension fund in America, or even if you're a high wealth individual, one of the safest and surest ways to make pretty good money from an investment was to buy mortgage-backed securities. That's where they just take all these loans and put them all together into a package. And then you as an investor are able to invest in that package of loans. And you get single, double-digit returns. It was always safe because nobody made mortgages at one time in this country that weren't sustainable and weren't responsible loans. Nobody made loans to people who they didn't think couldn't pay them back.
Safe investments like bonds were not giving much return, and so there was money all over the world looking for places to park, and mortgages were generally considered safe, and so there was a huge appetite for these mortgage securitization packages, and so they just needed to feed that machine. It was just this huge appetite, and let's just feed it, so you needed a continual supply.
Traders who could be 25, 30 years old could be making $1 million, $5 million, and they were incentivized to push out bad loans to ordinary Americans because they could package and sell them and record big profits. And so the story of compensation that led to the financial crisis is actually not only an executive compensation problem, it's also a compensation problem on the front lines.
They were mortgage-backed security salesmen. You can actually see the demarcation lines where people were wildly packaging up mortgages and selling them off as mortgage-backed securities. And the way their bonus was set was how much revenue that they generated based on selling this crap. That's what you get paid to do. That's your job. Well, guess what? You're going to do that every day, all day. And you're not going to stop until you can't do it anymore.
Wall Street had constructed the ultimate financial fraud machine in which millions of low-quality, high-yield, predatory loans were generated by lenders across the country, brought into the bank, repackaged, and then sold off to investors as good investments. Yet as airtight as this system seemed to be, there was still the issue of how to get investors to continue to buy into mortgages that were becoming increasingly toxic. And so to ensure that customers never caught on to just how bad these mortgage-backed securities were getting, Wall Street turned to a third party to help them cover their tracks.
How do you get those people on the end to buy this crap? Well, you get the rating agencies, the credit rating agencies.
When I say the credit rating agency, I'm talking about Moody's, I'm talking about Fitch, and I'm talking about Standard & Poor's. They have another special place in hell for them because they have enormous amount to blame for this problem.
Their job was to look at each of these different securities and give a rating. Say, is this good, bad, crap, awesome? And what happened in the run-up to the financial crisis is that these rating agencies are giving AAA ratings to securities that did not merit the ratings.
80% of these high-cost loans, the loans that got us into trouble, 80% of them were rated AAA.
Highest rating imaginable. Like, how high is a AAA rating? That's the United States government debt. You want to buy a bond, right, from Uncle Sam, it gets a AAA rating.
What we learned, ultimately looking at the bond rating agencies, is that they didn't bother to check what house was backing up this mortgage for $100,000. houses that today are probably worth $8,000 or $10,000. Nobody checked.
You could have put a first-year intern on a computer, sat him down, and said, go check the appraised value of these properties. It would have required a minute on a computer to say $50,000, but wait, the mortgage is for $150,000. Wait a minute, how can you do this? And that was going on over and over and over and over. And the reason they refused to stop this, and they've been interviewed and they've talked about it, because they knew that if they didn't do the business, it would go to their competitor. The way these rating agencies are paid is the banks pay them. If I'm at Moody's and they're like, oh, I don't know about these aren't as strong as we'd like, you say, that's all right, I'll go to Fitch, or I'll go to S&P.
If they actually said what they thought these loans were, then they would have lost business. So when Countrywide came forward, or New Century came forward, or Bank of America came forward and said, we want you to rate these loans and we want you to give them an A rating, yeah, we gave them an A rating, and they weren't measuring anything except for what the lenders told them to risk.
One point in this madness, it was accounting for about 1/3 of their income. And I've heard people say, well, if we don't do it, they'll do it. So they did it. They all did it.
With the scheme fully implemented, mortgage-backed securities began generating billions in fraudulent revenue for the Wall Street banks who were selling them, translating into millions in bonuses for their executives. Yet while all of these mortgage-backed time bombs had now spread into the wider economy, it would still require one further innovation from Wall Street to take them from incendiary to full-on nuclear. Those innovations were known as derivatives. Wall Street often depicts derivatives in complex mathematical terms, making them seem so sophisticated that the rest of us mere mortals simply assume that it's useless to even try to understand them, which is just how Wall Street wants to keep it.
The stuff, yeah, is made to sound complex, but actually it's really very straightforward. Always the story is one of too good to be true. That somehow we take something that is really super low quality as an asset. That's something that is called toxic by the people in finance. And then somehow we transmute it like lead into gold.
Once a mortgage-backed security was created out of an underlying pool of bad mortgages, those securities would then be bundled even further into a kind of derivative known as a collateralized debt obligation, or CDO, which despite their AAA ratings, were just as rotten as the mortgages they were stuffed with.
CDOs are collateralized debt obligations. So what you do is take a whole bunch of mortgage-backed securities, and we're going to take the cash flow from them, and then we're going to create priorities as to who gets first dibs on the cash flow. And that first priority, that's going to get AAA. Now, that could work if you did a little sliver, right, and had huge priority, but that's not what they did. They did the opposite. They said the whole 80% of the deal gets a AAA and gets first priority to the cash flow. Now, that can't possibly work. Once the loan originations are fraudulent, once you resell them into the secondary market, they don't suddenly get pure. They have to end up still being fraudulent.
CDOs were often 60 to 90% filled with fraudulent mortgages, yet banks were selling them as 80% AAA. This not only defrauded investors, but made it almost certain that they would lose everything that they put into them. However, for every one of those long investors, there was a short, or a short-term investor, who had no interest in buying CDOs. And so for these folks, banks developed a completely different type of derivative.
What happened was there was an introduction of a product called a credit default swap. And that kind of sounds somewhat complicated, but think of them as insurance contracts. So just like you and I buy insurance on a home or a car, and we pay a premium, a regular payment, and if there is an accident of some kind, then we get the value of the home or the car given to us. Same kind of thing. You can buy CDS contracts on debt, on risky debt.
The analogy of credit default swaps to insurance is a good one. In fact, many CDOs had this insurance attached to them to help justify their AAA rating. However, advertising credit default swaps as insurance was misleading at best. In reality, they were something much more insidious.
So what does insurance actually require? It sounds a little technical, but it makes perfect sense. It's called an insurable interest. What that means is I can't get insurance on your home. Because if I could take out insurance on your home, maybe I might burn your house down, right? But you could do CDS without having an insurable interest.
Speculators were allowed to select mortgages or groups of mortgages that they did not own, but they thought were going to fail. And many banks said, oh, you want to insure against their failure? We'll give you that insurance.
Second thing, if it's insurance, the insurance company has to set aside reserves now so that it can cover the losses later when they actually come, right? AIG, because it wasn't insurance, established 0 loss reserves. I don't mean nearly 0, I mean exactly 0 in the way of loss reserves. And then it gets really crazier, but of course very understandable if you know that the guy who did it got huge bonus for every one of these deals. And his bonus would have been non-existent if he had set aside appropriate reserves. So guess what choice he's going to make? This is not genius, this is audacity.
Even then, there still wasn't enough product to generate the amount of profits that they were seeking from the system. So they came up with synthetics. And what synthetics are is not actual securities, it's bets on securities. There's already a mortgage-backed security out there. The Wall Street Bank will have a bet against it. They'll bet that it fails. And then the other side, the person who's taking the other side of that bet will say that bet that it succeeds. And that becomes something called a synthetic bet.
I'm going to bet the mortgages are failing, even though I don't own them. But I'm going to go to the window, place my bet, like I would at a horse race, on the failure of these swaps. Well, states like Nevada started saying, wait a minute, this is gambling. You can't have gambling. So if you banks are going to do this, you better come to Nevada and register as a casino.
So what you had were, in many cases, 5, 10, 15 bets on a single MBS, so that people say, well, why should the subprime mortgage market have crashed the whole system? Well, it wasn't just the mortgages defaulting. The mortgages default, the CDOs default, the CDSs default, but then these multiple bets in CDSs and synthetic CDOs default. So anyone who's holding anything related to that group of mortgages is toast.
This whole system was a rigged system. It was all designed to maximize profits for all of the different players. The only people who were not in on it were the homeowners, who are getting pushed into homes they cannot afford with the devastating consequences that followed. And the other end, the pension funds, the sovereign wealth funds, the municipalities, they're the ones who got screwed.
Hey all, become that person nobody dares to argue with. Hit like, subscribe, and that little bell button for notifications. Talk to you soon.